In this section of the chapter, we're looking at notes receivable. Remember that notes receivable is another form of extending credit. Notes receivable is different from accounts receivable in the sense that notes receivable is more formalized. It has interest associated with it, and it usually exists for a longer period of time. Although it doesn't have to. As we're going to see here in a moment, we're going to look at both short-term and long-term notes receivable. Long-term notes receivable would be notes receivable that last for more than a year, and short-term notes receivable would be that lasts for less than a year. Remember, notes receivable gets its name because it's a formal agreement that's based upon a note or a contract that discusses the financing arrangement. Let's start by looking at short-term notes receivable and discuss short-term interest. Remember that simple interest is calculated as principal, the face amount of the note, times rate, times time. We adjust the rate here for the fraction of the year that the note has been outstanding. That's where this time period comes into play in the calculation. Remember, it's time always out of a year because the rate is always an annual rate. So we adjust for the number of months that the note has been outstanding during the year, not the number of months that the note has been outstanding for the duration of the note. For instance, if this was an 18-month note, and we had a 10% interest rate, and the note had been outstanding for 3 months, we would not multiply it by 3 over 18. This would be incorrect. And the reason why is because we're trying to adjust the annual rate, which is 10%, by the fraction of the year that it's been outstanding. So in other words, it would be 3 over 12, regardless of the fact that the note had a duration of 18 months in total. And looking at the first type of note, the short-term interest-bearing note, this is one that you would have been familiar with from a prior class. An example says, the Stridewell Wholesale Shoe Company manufactures athletic shoes that it sells to retailers. On May 1st, 2021, the company sold shoes to Harmon Sporting Goods. Stridewell agreed to accept a $700,000 6-month 12% note in payment for these shoes. Interest is receivable at maturity. Assume the interest rate is 12%. In this instance, we have a 6-month note, which means it's less than a year, making it a short-term note. Our journal entry to record this, because remember, we're from the perspective of the notes receivable is something that we're going to receive payment on later. So we're extending out the financing arrangement to others in order to make this sale. Our journal entry is going to debit notes receivable to increase it and credit sales revenue. We'd also have a cost of goods sold component with this as well because we're actually selling shoes in this case. But your book sort of excludes that to focus on the notes in this portion of the chapter. And then this happens at the date of sale, which is May 1st. Later on, when we actually collect 6 months later, the note principal and interest back, our journal entry is to debit cash for both, credit notes receivable for the principal, and then the interest is going to be calculated as the principal, $700,000, times the rate, 12%, times time, which is 6 over 12 in this case. That provides for us this $42,000. And then the combination of both the principal and the interest is what gives us the total amount of cash. This is the common type of note that you were exposed to in Accounting 111, something that you're already familiar with. If we had a situation where our note sale happens on August 1st and we have a year in that's calendar year, December 31st, remember that we have to prepare financial statements. And if we prepare financial statements at the end of that year, we have to disclose to those outside of the company, those who might be investors or creditors, that we have a situation where we have earned interest, we just haven't received that interest yet. So we have to do what's called accruing interest. That's our adjusting journal entry, again, that we practiced in previous classes, as well as in this class and prior chapters. Our journal entry would record the amount of interest that's outstanding as of the year end by debiting interest receivable and crediting interest revenue. Remember, we don't debit cash because we haven't yet received the interest. We receive the interest along with the principal being returned to us at the end of the note. Our calculation, again, is principal times rate times time. The amount of principal that we have is $700,000, the rate 12%, and in this point we have 5 months outstanding as opposed to 6. Remember, our sale took place on August 1st, so we have August, September, October, November, December, so we have 5 months. Then once we actually collect the interest and principal and We journalize it. Our journal entry is going to debit cash for the full amount, just like we did in the last one, but we've got to remove this interest receivable that we've accrued in the prior period. So we'll credit interest receivable for the amount that we recorded last period. We'll credit the notes receivable for the principal, just reversing this previous journal entry right here. And then we'll record the additional amount of interest revenue. You could use this as a plug, just the difference to make the journal entry balance, or you could go ahead and calculate it out. The difference here is that we've changed the fraction of the year to 1 month instead of 6 months, like in the prior example. So we record that additional month of revenue in January. A variation of the short-term interest-bearing note is the short-term non-interest-bearing note. And although it says non-interest-bearing, that's actually sort of a misdirect. The non-interest-bearing notes do truly, in their economic substance, they do truly actually have interest. It's just that their interest is embedded into the face value of the note. Well, let's see how this works. It says Stridewell Wholesale Shoe Company sold shoes to Harmon Sporting Goods on May 1st, 2021, accepting a 6-month, $700,000 non-interest-bearing note in exchange for delivering goods that have a cash sales price of $658,000. So essentially what's going on is that the sales price of the goods that we're selling is $658,000, but we accept for that sale a $700,000 note. The difference between the $658,000 sales price and the $700,000 that we're receiving is that interest. So when we record this transaction, our sales revenue only represents the selling price of $658,000. We've got a notes receivable for $700,000, and the difference is going to go to a contra asset account that offsets the notes receivable, this discount on notes receivable. So these two net together to show the carrying value of what the notes receivable is, and that $42,000 represents our interest, even though it is a non-interest bearing note. So to record the actual return of the face value of the note, our journal entry is first going to record the interest component. Even though it's not interest bearing, we record the economic substance of the transaction. And that is where we debit this discount on notes receivable, credit interest revenue. We're not actually receiving cash. Remember that the interest is embedded into the face value of the note. So when we receive the interest on that note, it's essentially part of that face value of the note itself. So the note return of that face value is representative of both the interest as well as the principal, so to speak, because the true sale was only $658,000. So we will debit cash and credit notes receivable for that $700,000, and that's indicative of both the interest and the principal that we're receiving as cash. We record the interest revenue as the offset to the discount on notes receivable when we reduce that notes receivable to zero. In this last example, we assume that the discount rate, the rate that was present in the market, regardless of the fact that this note in particular indicates that it's non-interest bearing, we assume that the market rate was 12%, and we use that for the discount rate. But note that the non-interest bearing note actually has a higher effective interest than those that are interest bearing that would actually indicate on the note 12%. And here's how this would work. Note that the actual sales price of the goods is going to be $658,000, and the interest that's reflected in the non-interest bearing note is $42,000 for 6 months of financing. So if we take $42,000 and divide it by 658, we find out the interest rate is actually 6.383% for 6 months. Now, if we were to normalize that to a yearly rate, we'd have to multiply that 6-month interest rate by 2 because there's 12 months within the year. And this shows us that our effective rate of interest on a non-interest bearing note, given that the market rate is 12%, is actually 12.766%. So the effective interest rate actually ends up being higher because the sales price itself was actually less than what the note face value was shown for. Similar to the prior example that we looked at, if we had a year end that comes in the middle of the note period, we'd have to accrue for the interest. So our journal entry here would debit discount on notes receivable, credit interest revenue. In the last example we looked at where it was an interest-bearing note, we debited interest receivable and credited interest revenue. Same sort of process though, we adjust for the amount of time. In this case, it's 5 months out of 12 because we started this on August 1st in this modification of the example. We account for long-term notes receivable the same way we account for short-term notes receivable, except now the time value of money has a more pronounced effect. Because of that, once we get past 1 year in terms of the duration of the note, then we're going to have to use time value of money calculations. In this example, it says Stridewell Shoe Company sold shoes to Harmon Sporting Goods on January 1st, 2021. Accepting a $700,000 two-year note in payment for the shoes and assuming a 12% effective interest rate. Here would be our journal entries. On January 1st, at the establishment of the note, we debit notes receivable. We credit sales revenue. And again, this goes back to a prior chapter that we looked at for the time value of money calculation regarding the note. So we use a present value single sum calculation for the $700,000 principal using 2 as our period and 12% as our interest rate. They indicate that the compounding, they don't provide us information about how it compounds. So we assume that it compounds annually here. So we just have 2 in terms of our period. We multiply this principal out times our time value of money factor that we pull from the tables that we looked at, or you can use Excel as the calculation. And this gives us our actual sales revenue. The difference between the principal or the face amount and the sales revenue provides for us our discount on the notes receivable. And then during that process of amortization on the discount, we are going to reduce it by the amount of the carrying value times the interest rate for each period that we have. So on December 31st, 2021, at the end of 1 year, we will multiply the carrying value, which is the amount of sales revenue that we started with, by the effective interest rate that we have, and this provides for us our debit to discount on notes receivable, our credit to interest revenue. And then at the end of the note's life, at the end of that 2-year period, we debit cash for that face value. We debit the discount on notes receivable for the interest amortization for this new period. And that's calculated again by taking the carrying value. The carrying value was originally the sales revenue, but now we've amortized a portion of the discount. So we add to that original amount that we had, that 558, the amount of discount amortization. Now remember, carrying value is calculated as the original notes receivable minus the discount. This provides for us our carrying value. Well, in this situation for the discount, we started with $141,964. So that was the amount we had. But then we amortize a portion of it right here. So we put $66,964 over here. This leaves us with a balance of $75,000. Now we could calculate that out. But essentially what we're showing here is that the original notes receivable was $700,000. And now we minus out our $75,000, and that gives us our new carrying value. Or another way that you could look at it is the 558,036 plus the 66,964. And this provides for us our new carrying value that we multiply by 12%. And that's how we get the amount of interest revenue and the discounted notes receivable that we're amortizing. And then we credit the notes receivable to reduce the original face value out, just reversing that journal entry portion right there. Remember, we're still dealing with a non-interest-bearing note. This is our effective interest rate that we have right here based on what the market rate is, but we're still dealing with a non-interest-bearing note, which is why we're not receiving cash directly related to that interest. Instead, it's embedded in the face value. Okay, last main topic for notes receivable. If we were to have a notes receivable situation where we loan out cash, even if it's a long-term note, if it's directly a loan of cash, then we record the amount at the face value. And this is true even if we have a 0 interest bearing or a ridiculously low interest rate, we still record the amount at face value. And the reason why is because the cash is seen to be considered the note's present value because we're actually giving cash. In the prior examples, we were selling goods and essentially financing the goods, but this situation, we are actually giving cash in the present day. And so the amount of cash given right there is seen to be the note's present value. All right, last little side note is subsequent valuation of notes receivable. Keep in mind that the same way we record allowance for doubtful accounts on accounts receivable, we would do those similar calculations and allowance for loan losses. So we'd have to estimate the amount of loans that we believe are going to be uncollectible and then establish a contra asset account in order to offset that amount of loan that we don't think we're able to collect. Calculations of these non-collectible accounts will follow similar calculation processes that we looked at in a prior class period where we calculate things like aging of receivables or percent of credit sales.